Well, in this week's video, I'm going to stay invisible because I need the screen because there's a lot I want to show you and I want to lay out the case. And when I say I want to lay out the case for what I'm about to do, I don't want it to just be me giving you my opinion of things. If you're looking for opinions on YouTube, just Google whatever it is you want. Long Tesla, short Tesla, long Bitcoin, short Bitcoin. You will find dozens of people telling you what their opinion is. The goal in the series that I'm developing here and that I have developed is to take the concepts that we see in the readings and apply them in the real world to see how well they travel from the pages of the book to the real world. Is there anything of value that can inform our trading decisions and inform our position on what we want to do, as opposed to us just listening to other people say, I think this and I think that. So we're going to walk through this a little bit slowly this week and next week. This week is currencies, primarily the US dollar. And if you've been through level 2, especially the time series analysis reading in quant, and the first reading in economics, which is about forecasting exchange rates, you will appreciate that it is brutally difficult to do in the short to mid-term, but there are some theories about a long-run equilibrium point to exchange rates, one of them being purchasing power parity. So we're going to look at that, and we're going to look at how effective it is. And in doing that, which this is everything you see on the screen, this is level 2, reading 10. In doing that, we're going to pick up on an interesting number. And then I'm going to show you the DXY, and I'm going to show you where that number shows up, and we're going to look at the long-term equilibrium path of the DXY based on that. And from that, we'll be able to determine a trend for the US dollar. In level 2 quantitative analysis time series, we looked at a few examples that looked at currencies as a demonstration of a random walk. And we note that whenever we do a time series on a currency, we get a unit root. And sometimes we get an intercept that's not significantly different from 0. That's a random walk. Sometimes we get an intercept that is significantly different from 0. That is a random walk with drift. We could describe the DXY over the last 4 years as a random walk with drift. And we'll look at that on the next screen. But let me just lay out the case for a cycle. Because we're going to see that the US dollar has about a 15-year cycle. Well, how does this 15 years come about? It's nice to say things move in cycles. We hear cycles from technical analysts all the time. That's the what. Okay, we can look empirically at a chart of the DXY, and we can see 15-year cycles, and I'll show you that on the next screen. That's the what. But I want to know the why. Why do we have these 15-year cycles? And I'm going to lay out what I think is a good reason why. In the reading for currency exchange rates on level 2, we looked at relative purchasing power parity as a forecasting tool for how exchange rates will move, and we looked at the relative and the ex-ante version of purchasing power parity, and we looked at forward rate parity. Relative and ex-ante purchasing power parity operate on inflation differentials. Relative looks at actual inflation differentials, and the ex-ante looks at expected inflation rate differentials. And it is saying that the percentage change in the spot exchange rate, and I have theta over USD, where I define theta down here as this. Theta is a weighting of 6 currencies, 0.576 on the euro, 0.136 on the yen. We have the British pound, the Canadian dollar, the Swedish krona, and the Swiss franc. This is the dollar index. That is DXY. And it has those weightings. So I just define all of that. This whole thing is theta. The percentage change in the dollar index would be the difference between the inflation differentials, or because we want to forecast, we would think about in terms of expected differentials. I'm going to make the case that there is a good probability, backed up by technicals, backed up by fiscal policy and monetary policy, that the US dollar could see 20% downside movement over the next 3 years. Well, to get 20% downside over the next 3 years, that's about 7.1% compounded per year. I don't see that inflation differentials between these countries weighted this way and the US could reach a differential of 7% per year. I simply don't see that. If we look at forward rate parity, it is the difference between interest rates. And again, theta being the DXY. I still don't see that interest rates are going to get to that differential. So we can look at purchasing power parity, and we can look at forward rate parity in terms of inflation differentials and interest rate differentials. We're not getting a lot of help there. I don't see anything that can help support an argument that we can probably lose 20% on DXY over the next 3 to 4 years. So we're not going to find much there. But this over here adds a lot of interest. This is Exhibit 2. This is the effect of relative inflation rates on exchange rates over different time horizons. So we're going to look at is a sort of a study on relative PPP. If you look at it, this is 1 year intervals. If you look at it every year and say, okay, we can observe actual inflation now. Did the currency behave like it was expected to do? Look at this. If it did behave like it was expected to do, we should see everything on a 45-degree line. Why? Because if the differential is positive, we should see the exchange rate as positive. That's what this is saying, right? And if it is negative, we should see the exchange rate as negative. Well, 1 year intervals don't tell us very much. Even going to 6 year intervals, they tend to cluster a little bit more, but they still don't tell us much. Look at what happens once you get to 12 years. And then when you get to 24. Now from 12 to 24, I don't see that there's much extra information, much extra precision that we're getting. 12 years makes the case. That if you go halfway between them, you get to 18. Even that may be too far. I'd say if this is 12, you know, to get it a little bit tighter, you might have to go out to 15 to 16 year intervals. Let's remember that, 15 to 16. Certainly not 24. 24 just seems that you're doubling the 12 to get to 24. You're not adding much explanatory power. We're already aligning fairly well on the 45-degree line. A little tighter would be nice, maybe just a couple more years beyond that. So this is telling us that if we are looking at inflation differentials in the short 1 year to intermediate 6 year time period, not really. It's not very helpful. And the reading does come to that conclusion saying in the short to intermediate term, it's not very helpful. But there is evidence indicating that it does hold that way in the long term. It never defined the long term. It really just gave us Exhibit 2. Implying that the long term is something more than 12 years and something less than 24 years in there. That by the time you get to 12 years, it kind of aligns. That actual inflation differentials had something to say about the long-term attractor point of the exchange rate. All right, that's the basis of what we're looking at. I really wanted to point this out because I want to show you something very interesting on the DXY, and the DXY is this over here. Let's look at the chart. All right, there is our 40-year chart on the DXY. If you're on Interactive Brokers, you type in DX, you'll get your list of futures your futures contracts up for the DX. And I believe the full ticker would be DX, then the year followed by the month, or it could be the month followed by the year. I don't know, but there it is. This goes back to 1980. Now, after we go through this chart, we're going to read, we're going to go back to the level 2 reading, and we're going to read one of the information boxes it has. It's not an exhibit. It's, you know, those little boxes where it has little stories about the real world. We're going to read one of them, and we're going to see how well it aligns with this chart. So we're going to bring in level 1 reading 56. Don't freak out. It's technical analysis. Yes, I'm going to use some technical analysis here because I think it really makes our story. So I'm going to draw a line from the peaks and of course the troughs over here. And what do we see? We see a downward sloping channel. We see a series of lower highs, and we see a series of lower lows. So from a technical analysis perspective, we have a secular bear market in the DXY. This is a 40-year chart that's drawn out quite consistently a series of lower highs and lower lows. What is interesting, though, is if you go from peak to peak, and this peak to this peak, this is about 15 to 17 years, this is about 15 to 6 years. If you go from trough to trough, this is about 15 to 16 years. This trough over here was just a little before 1980. This trough over here was about the end of 93. So this is about 13 years, not quite the same 15 to 16 years. And then if we draw from this base over here too, and then we have to stop because, well, are we going to revisit the lower trend line? We have consistently, so there's a belief that we're sitting right up here right now at 90. We have a line of support because we have a previous low over here. We'll look at a 5-year chart soon, and the 5-year chart will expand this section. But if we trade to the lower end, where would that take us? If we assume a 15 or 16-year cycle, this low was 2008. That was the March low, March 9th. It was 71.657. So we'll add 15 to 16 years to 2008. We get to 2020 to 2023 to 2024 for what a technical analyst might say is the time target to make a new low. Now we'll probably take out the March low before that point in time, but that we should be making a low sometime at that time. It would be consistent with the cycle. Not only that, it would be consistent with the long-term trend of purchasing power parity, of relative purchasing power parity. And what we can do for this is, let's find the middle of this trend, which looks like it could be about there. And we'll draw a dotted line straight down the middle here, because this is our attractor point. This is what the theorists would say is the long-term trend for purchasing power parity. That at these points, the currency is trading at its relative purchasing power parity. It would describe these as overshoots and would describe these as undershoots. And that in the short to medium term, we would expect the currency to cycle in and around its long-term purchasing power equilibrium trend, which is downward sloping. So we have some theory pointing to the downward sloping trend in the DXY. We have some technical analysis that we brought in that supports that story as well. In the screens that come up, I'm going to overlay the fiscal story and the monetary story to this, and we're going to see that all of them are suggesting that we have a more downside to the DXY, except for one thing. And I don't really know if it's going to do much more than a short-term effect. Okay, so we've got all of this. What else can we bring to bear on this story of why? Why would we see this downward sloping trend? Clearly it's there. Theory tells us that something like this would be there, and we found it. Much like Einstein said, there are gravitational waves, and then suddenly we find gravitational waves. Theory says we'd see something like this. Well, then, here it is. Let's see if we can come up with some compelling reasons. Number one, in 1960, the U.S. made up 40% of global GDP. In 2020, it only makes up 25% of global GDP. So U.S. economic activity as a percentage of global economic activity is becoming less and less and less important. Well, so what, right? In the 1960s, even earlier than that, I think much after, sometime after World War II, the U.S. Was the currency of international trade. Even among countries that did not use the U.S. dollar, most contracts were based in U.S. dollars, and especially for trade in commodities. So if Japan wanted to buy oil from Saudi Arabia, they didn't worry about their own currencies. It was in U.S. dollars. Japan got a hold of U.S. dollars. It paid Saudi Arabia. Saudi Arabia held on to those U.S. dollars, so that all central banks around the world had U.S. dollar reserves. And those U.S. dollar reserves are still quite high, even by today's standards. I think something like 55 or 65% of central bank reserves are U.S. dollars. But there is less need for that now. Now, to be sure, there is more trade conducted in 2020 in pure dollar amounts than there was conducted in 1960. But we're looking at the percentage of the trade. 40% was a compelling reason to use a common currency like the US dollar. At 75%, it's less compelling. And we are seeing that some countries have been willing to abandon the dollarization of contracts and the dollarization of international trade, mostly China, which is the second largest economy on the planet. Well, you can't ignore that. They are willing to conduct international trade in euros, in a currency other than the US dollar, even on contracts where the US dollar has been the de facto standard for a long period of time. So trade between Russia and China, for example, for energy, for oil, is more and more not conducted in US dollars. Well, that's less demand for US dollars going forward. So when you have less demand for US dollars going forward, you would expect to see over time less and less pressure or upward price pressure on that, more downward pressure on the US dollar over long periods of time. I'm not talking about the overshoots and undershoots. We'll look at something related to that shortly. Another very compelling reason, and the reason that I think is a bit more powerful than just international trade. By the way, if you're looking for where we discuss international trade in the CFA curriculum, that's level 1 reading 18, a whole reading on international trade. The debt sustainability channel, we discussed this at level 2 reading 10 for determining does the current account balance have anything to say? Is there a channel there that affects the exchange rate? And one of them is debt sustainability. And this relates to countries that run persistent current account deficits. Well, I think the U.S. Holds the record for this now. I think since Nixon took the dollar, stopped converting the dollar into gold back in '71, the U.S. has run a current account deficit and has never looked back, has never run a current account surplus since. So you're talking almost 50 years of current account deficits. So current account deficits over time will lead to a depreciation of the currency. So the U.S. being less of a presence in global GDP. When I say less, 25% is still a lot. For a country with 5% of the population, it's still a lot. But down from 40 down to 25, and as China continues to rise, as Asia Pacific continues to look into itself, as India continues to rise, then even if the U.S. continues to grow, it will be less and less of a share of global GDP. But I think this is your bigger one, is you're running current account deficits. So you can't have a country that says we have a strong dollar policy, but yes, we recognize we have 50 years of current account deficits. At some point you must say, wouldn't it be nice to have a current account surplus? Wouldn't that support a strong dollar policy as opposed to just saying we support a strong dollar policy? And we're going to see in a few screens that Janet Yellen, coming into the Treasury, has got a bit of a problem because the Treasury has always supported a strong dollar policy, but Yellen at the Fed was supporting more of a weaker dollar policy, saying a strong U.S. dollar is a headwind to growth. What's she going to do now, right? Anyways, let's do a little bit of reading. But before we do that, have a look at this. This is the beginning of the 1980s over here, and then we have this major drop in the second half of the 1980s. So from 1980 to about 1983, strong U.S. dollar, followed by weak U.S. dollar. We went sideways for a period of time. Second half of the 90s, strong U.S. dollar, followed by weak U.S. dollar. Here's 2001. Here's George Bush's wars, right? All the way down. Wars require financing, which means you got to run deficits and you got to borrow money to finance a war. And there we go. Let's do that little reading first. Okay, you will find this in your level 2 reading, reading 10. Persistent current account deficits, the U.S. current account and the U.S. dollar. It's not very long, it's very short, so we'll read it. I know that some people prefer to read on the screen themselves, so I'll place it in the middle of the screen. You can hit pause and read it on your own, or I will just read it here. The historical record indicates that the trend in the U.S. current account has been an important determinant of the long-term swings in the U.S. dollar's value, but also that there can be rather long lags between the onset of a deterioration in the current account balance and an eventual decline in the dollar's value. For example, U.S. current account balance deteriorated sharply in the first half of the 1980s, yet the dollar soared over that period. That was that first run-up I showed you from 1980 to about 1983. The reason for the dollar's strength over that period was the high real interest rates attracted large inflows of capital from abroad, which pushed the dollar higher despite the large U.S. external imbalance. This was 1980. Reagan came in. Reagan said, we got a problem with inflation. We need this solved. Handed the Fed over to Paul Volcker. Paul Volcker said, it's going to get uncomfortable. And Reagan said, do it. Just do it. We've got to solve this problem. So Volcker raised interest rates 17, 18% and crushed inflation. Well, when you're getting 17, 18% on treasuries, your money is running into that country, right? And sure enough, it broke inflation. And from 83 onwards, inflation went straight down. Eventually, however, concerns regarding the sustainability of the ever-widening U.S. current account deficit triggered a major dollar decline in the second half of the 1980s. And that's exactly what we saw on the DXY. History repeated itself again in the second half of the 1990s, with the U.S. current account balance once again deteriorating while the dollar soared over the same period. And we did see that. If we look at, let's just flip back to it very quickly. Second half of the 90s, here we are 95, here's 2001, and the dollar soared, even though we have wider and wider, more and more. If you think about it in a cumulative sense, the current account deficit was growing larger and larger. Also, the second half of the 90s had some issues as well that required the U.S. dollar as a safe haven, the Asian currency crisis. And under Clinton, by the way, the U.S. did run surpluses and was reducing its debt in the later half of the 90s. So you did have this nice run-up over there. But let's get back to our story over here. Dollar soared over the same period. This time, the dollar strength was driven by strong foreign direct investment, as well as both debt and equity-related flows into the United States. Beginning in 2001, however, the ever-widening U.S. current account deficit, ever-widening because we were involved in two wars. We jumped, or I say we, collectively, coupled with a decline in U.S. interest rates, and this is under Greenspan, brought interest rates down to 1%. Decline in interest rates, where we made it more difficult for the United States to attract the foreign private capital needed to finance its current account deficit. The dollar eventually succumbed to the weight of ever larger trade and current account deficits and began a multi-year slide starting in 2002-2003. Interestingly, the U.S. dollar has undergone three major downward cycles since the advent of floating exchange rates: 77, 78, 85, 87, and 2002, 2008. If you add 15 years to 87, if it goes 85 to 87, add 15, gets you to 2002, right? Just interesting. In each of these downward cycles, the dollar slide was driven in large part by concerns over outsized U.S. current account deficits coupled with relatively low nominal and or real short-term interest rates, which made it difficult to attract sufficient foreign capital to the United States to finance those deficits. Let's just look at this last sentence because it says a lot about where we are and a lot about the future. In each of those downward cycles, the dollar slide was driven in large part by concerns over outsized U.S. current account deficits. Let's stop there. What are we running right now in the U.S.? Major deficits. Well, you've got COVID and you've got a lot of spending going on. Huge deficit this year. Do you see that ending? Do you see that reversing? Do you see the U.S. suddenly saying, that's it, enough with the spending under Biden, and we're going to reverse? As I speak, $900 billion more looks like it's going to be approved and sent out into the market. Democrats are not going to stop. They're going to want more. They take the two Georgia seats in January's election. You know they're going to spend more. Do you see any end to the U.S. current account deficit after almost 50 years? No. And this is saying that it was driven in large part by concerns over outsized U.S. current account deficits. I see this continuing. coupled with relatively low nominal and or real short-term U.S. interest rates. Well, we have very low nominal rates, and if you factor in inflation, for many of the maturities, you have negative real interest rates. So it's even worse. It's not that we have low real interest rates. We have low nominal rates, negative real interest rates, and budget deficits we've never seen before that are expected to continue for the next 3 or 4 years. Well, if the long-term trend has been driven primarily by those two things, and we see those two things present now and expected to continue for a period of time, well, what do you think is going to happen to the DXY? I don't see a reversal in that trend from either a monetary interest rate argument. The monetary is interest rates, fiscal is the spending. I don't see anything changing on the monetary front or anything changing on the fiscal front that tells me that suddenly we're going to turn around, we're going to turn off the taps, we're going to shrink the size of the balance sheet, we're going to shrink the money supply, we're going to close the current account deficit, that's the trade deficit, we're going to close the current account deficit and really boost interest rates. If you wanted to ask me what is the last thing that would happen, I would say that. So it's hard to make a bull case for the DXY, but it's super, super easy to make a bear case for the DXY. Okay, let's look at monetary policy and fiscal policy now, just to put 2 more nails in the coffin here. Actually, before we get to the monetary and fiscal, I wanted to show you the 5-year DXY. We're just zooming in on the last 5 years, and I had a purple line drawn. And I'll redraw it here for you, and it was just to show where the current level of support is right now on the DXY. And we'll try, technical analysts like to get the lowest closing, I think somewhere in the consolidation. So you have consolidation in this period here. I think if you draw your support line through consolidation, that's enough. But if I were a pure technical analyst, I'd be saying there, here's my low point, that is my lowest close. This chart becomes extremely bearish if we close below the last close, but good enough. I like to just draw it in the middle somewhere of the consolidation. So we're at 90.02, or that was the closing on Friday at 90.02, just sitting, if you really want to use the lowest point in early 2018, sitting about 3% above the support line right now, and we've sort of made a run right to it. Are we going to break that support line? Given the trend that we're on right now, given that I don't see anything reversing, I cannot make a case for why we would find support there all of a sudden and turn around. Everything from the technicals to the theoretical to the monetary to the fiscal, all are supporting a lower DXY. So yeah, I think you could break under there, with currencies, it's hard to forecast. It is brutally hard to forecast. All you can do is come up with a weighted probability, saying, if I had to bet, the probabilities are in favor that we would break that low. What I find interesting is this: we look at this consolidation period and we look at this consolidation period, and I'm discounting this spike. That's your initial COVID spike. It didn't last long. It pulled back right away. In technical terms, we would say, it didn't breach the top over here, but if it did, this major pullback right after, that's called a false breakout. So that really we could say that was sort of the peak there. Notice that even with COVID, even with this high level of uncertainty, you had the S&P sell off 1,000 points. The dollar index failed to make a new high. And this is back when there was not that level of uncertainty. We didn't have a level of fear and level of uncertainty. Markets weren't selling off like they were in March to mid-April. But the dollar index failed to make a new high. I find that very interesting. It's sort of telling me that the safe haven status of the U.S. was not enough to overcome the underlying weakness in the U.S. dollar. So down we go. It was this COVID event over here that, added trillions of dollars to the deficit, and the Fed's balance sheet expanded dramatically. Rates were slashed all across the board. So while there might have been thought that, hey, we might be moving in a direction that makes sense, it looks like the long-term trend of ever-increasing deficits, current account deficits, low interest rates, negative real yields, these are going to weigh on the U.S. dollar. All right, let's look at the Fed statement, and let's look at what we think is going to happen, or what the Fed is going to have to do to meet the fiscal policy. Okay, let's begin with what we know, and I'll put it in brackets up here. This is, as of today, we know this. This is fact. The Fed, at their last meeting, made an announcement that they were going to keep rates low until at least 2023. Remember on the DXY chart when I said let's draw out the next low, where would that be? If we take 2008 and add 15 or 16 years, we get to 2023 to 2024. There's 2023. We're going to keep rates low until at least 2023, and this wasn't unanimous. There were only a few on the committee that thought 2023 was the right time to start thinking about a rate increase. The rest were further out. So it's 2023, up to 2023, everyone's unanimous that rates aren't going to move. Some think they have to in 2023. They're going to continue their asset purchases. They announced no expansion. $80 billion in U.S. Treasuries, $40 billion mortgage-backed securities. Balance sheet's going to increase by $120 billion a month. That's $1.44 trillion over the next 12 months. But in the press conference, Powell said we may increase. We may change the pace of asset purchases. We may change it in two ways: maturity and quantity. Maturity means we may keep $80 billion in treasuries but step further out on the curve to push rates down at the longer end of the curve, or we may increase the quantity. So he says we may do it, so the question is, well, will he? I think he will be forced to do it. And let's look at the fiscal. So this is the monetary, this is the fiscal, and we're going to see, what I'm going to do here is I'm going to erase this and redraw this for you so that you'll see how that got to be, and we'll draw our upward sloping yield curve, which we have right now. Powell is actively encouraging fiscal stimulus. How many times has he said, look, all we can do is lend, we can't spend, you need to spend, and he's telling the fiscal side, you guys need to come up with a spending bill. You guys need to spend money. Well, if you have a credit card and you need to spend more money, but you have no money, what do you got to do? You got to use more debt, which means somebody has to finance you. It's your credit card company's got to finance you if you want to spend more and you don't have a surplus, if you're already in deficit. So that's going to result in a larger deficit. That deficit must be financed. So if you're going to have, let's say worst case scenario, it's not just $900 billion that's going to happen, but let's say that the Dems find a way, with or without Georgia, find a way to put more spending out of Congress. Well, you're going to have to finance that. And if they do take Georgia, you could be talking $2 trillion, not just $900 billion, but $2 trillion, $2.5 trillion. So it could get very, very ugly. Well, that's going to have to be financed. They finance it by selling treasuries. They'll tell the Treasury, they'll tell Janet Yellen, okay, here's what we need. Go ahead and sell some treasuries. Well, that's going to be more supply on the market. And if the willingness isn't there to absorb all of that supply at negative real rates, by the way, negative real rates, if the appetite isn't there, this is what's going to happen. You're going to have a curve that starts doing this. Rates are going to start going up. Inflation expectations are going to move into the long end of the curve dramatically. Well, what's going to happen is the Fed's going to have to come in and push that back down, which means it's going to have to increase the quantity to absorb all of that supply. But that still is going to affect inflation expectations, so you're going to have to step out on the curve a little bit longer to push that down, which means you're going to push real, long-term real interest rates into negative territory to keep low nominal rates, because that inflation expectation will be built into it. Now, you may have an inflation expectation built in. Somebody asked me, how come how come investors would still buy bonds with negative real yields? And the answer is, well, how do you know they're negative? It's an inflation expectation, not an actual inflation rate. It's an expectation. So the belief is the expectation is wrong. The belief is there's going to be no inflation, and it's actually a positive real yield after the fact, because before the fact it looks like a negative real yield because you have this high inflation expectation. But it's only a real negative yield if inflation is actually high. If it's not, it's still a positive real yield. And that's the bet that's going on when you have negative real yields and positive nominal yields. The belief is, look, inflation's just not going to be there, so who cares? We're good with this. If the Fed is buying, that's where we're going to sit. We don't see inflation. So those buying bonds with negative real yields are betting against the inflation expectation. Because if they believe the inflation expectation, nobody would say, yeah, sure, give me less money in the future. Anyways, so the Fed's going to have to buy more, and it's going to have to buy longer dated treasuries because this has to be financed. So the size will expand and the maturity will expand, so this is going to happen. So the Fed balance sheet will increase, the money supply will increase, and we'll talk about the money supply more next week. But I'll end a little bit on the money supply just to give you something to think about for the inflation argument we'll be making next week of whether it will be there or whether it won't be there. But from a monetary perspective, I see low rates until 2023 because I believe him. He said it. I believe him. I don't see any reason to doubt him. It's not like he's lying. I believe him. He's going to continue to expand the balance sheet by 120 billion a month. I believe him. He wants the fiscal side to spend more money. I believe they will. I believe they'll spend more than what they're announcing right now. I believe that. He said he may increase the quantity of purchases and the length of maturity. I believe that that will happen as well. The fiscal, the monetary, the technical, the theoretical all point to a deteriorating US dollar. Okay, so we make that point. What do we do? Do we short the US dollar? And last week I said, look, you can think of the stock market as two games, a game of checkers and a game of chess. And the game of chess is hidden in behind the game of checkers. A lot of people play the market like a game of checkers, which has a healthy dose of luck involved in it as well. Whereas with chess, you have the move that you're playing, but you're really playing 2-3 moves ahead. You're never playing just the move you're on, you're looking ahead. A game of checkers would say short the US dollar. Well, short the US dollar against what? You can pick some good currencies. Any of the currencies in the DXY make a lot of sense. The euro has the heaviest weight. I would avoid the British pound, but the euro, the yen's been strengthening. The Canadian's been strengthening. I'd even step outside of that and look at the Mexican peso. The three favorites that I always like are the Canadian dollar, well, because I'm in Canada, right? The Canadian dollar, the Mexican peso, and the Australian dollar, especially if you're bullish on commodities. The Australian dollar. By the way, the Australian dollar, Australia, other than where we are now, I think since mid-'80s, early 80s, has never had a recession. And I think has some of the lowest debt to GDP of any country out there. So something to look at. So you can look at those. Most checker players or most market participants playing checkers will say it's gold. You got to go for gold. Gold and lately silver. Silver's flag has been flying high. Gold and silver. You got to go for gold and silver. Well, I'm going to make the case for gold. On the next screen, I will make the case for gold. I will also destroy the case for gold, but I will make the case for gold, and I'll make the case for silver. I think long commodities make a lot of sense. The long commodity story takes 3 weeks for me to explain. I have to explain a weakening US dollar, number one. Number two, you also need economic activity to support a rise in commodities. And number three, you need inflation. Any one of those three are supportive for commodities, but when you get the intersection set of all of them, so if we think about that being a weaker dollar and all of the possible trades that could happen in there, And we think about increasing global economic activity and all of the trades that can happen in there. And we think about rising inflation and all of the trades that you'd want to be in for rising inflation. Here's where you want to try to get. You want to try to get in this intersection set where all three of these things would support that, because you only need one or two of them to happen to be supportive. You have the highest probability of being right if you can get into that intersection set. Being down here, if inflation doesn't show up, well, economic growth and a weaker dollar aren't going to help you. I want to be somewhere where I'm helped. If only one of these things show up, at least it's going to help me, right? So I want to be in that intersection set, and that's where I think commodities are. So commodities require a weaker US dollar argument, requires an inflation argument, economic activity argument, and an inflation argument. We're going to do inflation next week, and we'll talk more about commodities next week as well. You can also think about emerging markets with a weaker US dollar, especially countries who have external debt denominated in US dollars, because as the US dollar weakens, their currency strengthens against the US dollar. Suddenly, their ability to finance US dollar debt becomes more manageable. Because they have a stronger currency. They don't have to sell as much of their currency to buy US dollars to meet any coupon payments or to meet any principal payments. Typically, these countries are also net exporters of raw materials, including commodities. So if commodity prices are moving up in US dollars and their external debt is in US dollars, that's great for those particular countries. And since they are, if there's going to be a secular or a cyclical bull market in commodities, those countries also tend to see a lot of foreign investment, which then drives up their currencies and drives up their markets as well. So emerging markets, especially, like I said, especially ones that have a level of U.S. Of external debt denominated in U.S. dollars. All right, let's look at gold. I'm doing a couple of things here I sort of avoided over the years, talking technical analysis, and I'm about to talk about gold. I don't know how many times I've been asked, what are your thoughts on gold? And I say, I don't have any thoughts on gold. But I'll talk about gold. And for everybody who's asked, what do I think about Bitcoin? I will talk about crypto on the next screen. You're not going to like what I have to say. And if you don't like what I have to say, you can push back on what I say with logic and facts. But if all you can do is call me names, you're in the wrong place. I'm going to block you. I'm firm on that. All right. I think this is extremely interesting in digging into gold and looking at where gold seems to shine the most. Let's look at gold, and I'm going to choose 1970 for both gold and the S&P 500. Reason I'm taking 1970 is the chart I used just started at 1970. It's also because gold was $35 an ounce. It was the lowest price that it was, and then it was never below 35. So let's give gold the biggest bull case possible by picking the lowest price it could have been. I'm not going to pick some place where it had a higher price to show a lower return. We'll go right to the point where it was the lowest. 1970 to today, if you bought $1 in gold in 1970, it's worth $53.63 today. That's an 8.29% compounded annual growth rate. And all these are pre-tax growth rates. We won't worry about taxes for now because every country is different. We'll just look at pre-tax. 8.29% compounded annual growth rate per year. In 1970, if you would have bought the S&P and held it to today, it was a 7.65% compounded annual growth rate. So the gold bugs would say, see, gold is where you want to be. But this is a price only. This is a price only index. That's not a total return index. The index has a dividend yield. So if you Google S&P 500 dividend yield historical or history, you'll get the dividend yield from 1970 all the way to today. So I figured out what $1 would be invested in the S&P in 1970 based on the growth and based on the dividend yield. And I get, and you will get, to 10.56% compounded annual growth rate on a total return. The S&P 500 outperforms gold over this 50-year period by 227 basis points a year. $1 in 1970 invested in the S&P grew to 151.19 with dividend reinvestment. Gold doesn't have a yield. Gold doesn't pay a dividend. Gold actually has a storage cost, so it actually has a negative yield associated with it. I didn't include that in here. When you're looking at buying gold, you're buying it through proxies, which are going to have management fees or storage costs associated with it. That's not in the 8.29. On a total return basis, equities over the long term have outperformed gold. 10.56% compounded annual growth rate versus 8.29 for gold over the same period of time. The further back you go, the compounded annual growth rate gets worse, because if I bring this back to 1969, gold was still $35 an ounce, which means its growth has to be compounded over one extra year. This would just drop. But if I went back one extra year on the S&P to 1969, it was lower, which means this would just end up being higher. Sometimes we can look at what things cost in terms of an ounce of gold. And I've seen this analogy done, that in 1940 it took X amount, it took so many ounces of gold to buy a car. Today it takes so many ounces to buy a car, and you can see that it takes fewer ounces of gold today to buy a car than it did in 1940 because of gold's store of value and its hedge against inflation. If you had bought the S&P 500 in 1970 with gold, you would have needed 2.6 ounces of gold to buy the S&P. Based on the price today, you'd only need 1.95 ounces of gold to buy the S&P today. But again, that's a price index. You have to look at a total return index. If you want the same total return over the same period of time, it would take 7.5 ounces of gold to buy the reinvested dividends, the total return over that period of time. So it would have cost you 2.6 in 1970. It grew to 7.5 ounces of gold over that period of time. So you can't just look at the price, you got to look at the total return, because equities have a yield. Don't forget that yield. It's not just the price difference, it's the yield. Gold has no yield. Sorry, gold bugs, but it doesn't. You hold an ounce of gold, if you come back in a year, you don't have 1.03 ounces of gold. You didn't get a 3% yield on it. It's not there. In fact, you can't hold that ounce of gold. You got to keep it somewhere, which means you're paying storage fees. You're going to have less than 1 ounce of gold. Okay, so there is, over the long term, the case for equities being superior to gold. But hold on. Before the gold bugs start screaming at me in the comments section, here's where you guys really shine. What I did was I just looked at periods where the DXY were dropping, and for the first period I get January 1st, 2001 to October 2007. The DXY dropped 40%. Gold increased 175%. Now, the equity markets increased as well, but not 175%. Gold outperformed equities when the DXY dropped. From 1007 to 0411, the dollar index went sideways over that period of time, over 4 years. It showed a meager increase of 3.5%. Gold showed a return of 94%. The money supply was hugely expanded over that period of time. And just to contrast it with the DXY dropping, let's look at a period of time where it increased. From 0411 to 0716, the DXY increased 37.6%. There, you see gold underperformed. Gold underperformed, and equities significantly outperformed gold over that period of time. We think of gold as a hedge against inflation, and it does have the capability of hedging against inflation, but it is a much better hedge against a weaker US dollar. If you look at gold being priced in US dollars, if the US dollar is weaker and weaker, it's going to take more and more dollars to buy the same ounce of gold. So if we think, and remember that chart we looked at where we had a low, and if we think the US dollar index is going to make a new low, and the low was at 71 point, well, let's call it 72 to be friendly. We're at 90 right now. That's a 20% downside. So if we're going 20% down, look what happened when the DXY here dropped 40%. Gold went up 175%. So even cut that in half. You're looking at an 80%, a possible 80% increase in the price of gold. If it's at $1,800 an ounce or $1,900 an ounce, 80% increase brings it to the mid 3,000s. I haven't seen price targets like that. I've seen 2,300, that if we can close firmly above 2,000 on gold, it could run to 2,300. So yeah, gold, if we think that we're going to get a weaker DXY, a weaker US dollar over the next 3 to 4 years, yeah, gold will probably outperform equities during those periods of time. Layer on inflation onto that, gold will appreciate with inflation reports as well, but equities do as well. Equity, if you have higher than expected inflation, as long as it's not uncontrolled inflation, and you have a central bank, so you're not going to get uncontrolled inflation. As long as it's not uncontrolled inflation, neither one of them have an advantage over the other. Equities will perform just as well in an inflationary regime as will gold. So the only tip of the hat I give to gold is, if you have a weakening US dollar, gold is a good place to be. But so are any commodities. All commodities that are denominated in US dollars will go up. I'll give you a pound of copper, but if you're going to give me cheaper and cheaper US dollars, you got to give me more of those US dollars for the same pound of copper. So almost all commodities will increase. And if we layer on economic activity, I prefer base metals as opposed to gold. Gold being a precious metal, fine, but if we're going to have economic activity along with inflation, along with a lower dollar, I would rather be in base metals. Because demand will push those prices along with the weaker dollar, along with inflation. What about silver? Silver is roughly about $26 an ounce right now. Silver will be pulled along with gold. It used to be that gold was equal to 50 times silver. So if you have gold at $2,000 an ounce, which we're call it 1,900, we should expect to see silver around $50 an ounce. $40 an ounce, not 50. $40 an ounce. 50 times 40 is 2,000, and we're at 26. You got a 50% increase just to get back to this historical relationship. I don't know if that historical relationship will still hold. But if you are a believer in that we are eventually going to get back to that, silver is currently undervalued where gold is. And if gold is going to go up, silver will get pulled forward. And silver is starting to get more and more coverage. So you're seeing growing sentiment around silver. Well, that's good. I don't have to believe in silver, but I do believe in sentiment. So if I see a growing amount of sentiment around something, I can go ahead and buy that thing, and the thing I'm looking at is sentiment. I know when to get out when sentiment starts to fade. But right now, sentiment is growing for silver. Almost everyone you listen to on Bloomberg is bullish on silver. Okay, silver is a cheaper place to be than gold. So you can look at silver. You can look at a 6-month trade on silver using options on SLV. SLV is nice. You can buy the calls, the $26 calls on SLV. You can buy the 26 calls, and you might say, okay, well, I don't think this is, this might go up, 30%. Well, 30% of 26 is about $8. You might go to 34 and sell the $34 calls and come down to about 19 and sell the $19 puts. Going out 6 months if you want to do a combo. Or you could just buy the 26 calls and say, here's what I'm going to do. I'm going to buy the 26 calls, and if silver starts to go up, I can hedge out by selling the $34 calls at an even higher premium, hopefully get my bull spread for $0 if it goes up enough. Or if silver starts to pull back, then you can step into a risk reversal by selling a put even lower to offset the price of the cost, however you want to do it. So there's an argument for gold, there's an argument for silver, but also a good argument for the S&P. if we think about, and I mentioned this last week, a large proportion of the revenues of the S&P is denominated in currencies other than the U.S. dollar. So if you do believe in a dropping U.S. dollar, you're going to have currency conversion, currency translation, I shouldn't say conversion, currency translation gains on consolidated statements. Whether those translation gains show up on the income statement or show up in the equity section, depending on what method of translation they're using, it still is an increase in the equity of the company. Whether it flows to equity through retained earnings because it showed up on the income statement first, or it just showed up in equity on its own, it is an increase in the value of the equity of the company. Just on currency translation, and if we think that we're entering a or going back into the secular bear market, that the cyclical bull market in the dollar index is over, and we are going to make new lows over the next 2, 3, 4 years. That's 2, 3 to 4 years of continual currency translation gains layered on top of what I think are companies that are best suited for a digital world, which are large cap companies. So, I can make the case for the S&P 500, and you're going to get your beta. You can make the case for gold. Well, there you're going to get a very specific factor exposure. You're not going to get your beta out of that. You're really playing the move on the dollar index. If I'm playing the S&P, I'm playing a lot. I'm playing large cap stocks. I'm playing a dividend yield. I'm playing a weakening U.S. dollar and economic growth all at the same time. I'm getting everything I want in one trade, as opposed to stepping outside and saying, give me a little of this, give me a little of that. If you are going to be short the U.S. dollar, if you're going to be long gold and silver, if you're going to be long commodities, you have a highly correlated trade. You're not diversified. You're exposing yourself to one big risk factor, which is the U.S. dollar. So depending on what you want to get into, you can say, look, I want exposure to this risk factor, but I don't have to have a pure play exposure to that risk factor like gold or silver. I can get all of that in the SPX, or the SPX, I'm giving you the ticker for it, the SPY. The SPX is the index itself, the SPY is the ETF. Okay, let's set up next week. Oh, sorry, one more thing here. You have Janet Yellen coming in as the head of the Treasury. And since about mid-90s, the Treasury has always followed a strong dollar policy. Fed chairmen, and Janet Yellen was one of these as well, when she was head of the Fed, was very cautious about talking about the dollar, and was cautioned all the other members of the FOMC. The dollar is the purview of the Treasury, not the Fed. We're not here to manage the dollar. The Treasury is there to manage the dollar, and they will do what they see fit. But she did warn against a strengthening dollar being a headwind against growth, but didn't go as far to say we should have a weaker dollar. Just saying it is a headwind to growth, and it is a headwind when we're talking about the current account deficit. So a stronger dollar will weigh on economic growth because it'll make exports more expensive and imports cheaper. And we know that imports are subtracted from GDP because they're not produced within the country. Head of the Treasury, what's she going to do? Support a strong dollar policy? Is she going to say, is she going to fight the White House and fight Congress and say, listen, I know that you guys want to issue this much debt, but it simply can't be done. I have to keep my eye on the amount of debt. I have to worry about the perception of a weaker dollar internationally. I have to be seen as supporting a strong dollar. So is she going to stand against that? I don't think so. I think initially she'll go along to get along. I think that she will side with Powell in a professional manner. I think she'll side with the Fed. I think she'll see that fiscal stimulus is the necessary evil first, and she might have a long-term strong dollar policy, but I don't know that she can overcome, I don't even think that any job owning will overcome all of the short-term negatives against the U.S. dollar right now. The technicals, the fiscal, the monetary. So, yeah, there is that wild card out there that she could come out strong and start talking up a strong U.S. dollar, and you could get a rally in the U.S. dollar based on just faith. but I think that will fade very quickly as the Democrats start spending, as the budget deficit increases. And I don't think it's just going to be 1 or 2 years. I think it's going to be bad for a while as the current account deficit still continues to weigh on the U.S., as the Fed balance sheet not only expands at the rate that it's expanding now, but expands even faster. Yeah, there's only so much talking you can do. Any action that she would take would be counter to all of those policies. That's not going to happen to a twice appointed Democrat appointee, which is Janet Yellen. That's not going to happen. So I don't see that occurring. Let's set up the argument for what we're going to do next week, which is inflation. And I'm not really going to say we're going to get inflation or we're not going to get inflation. I'm just going to give you the argument from two big schools of thought based on one equation. Sorry, before we go, I said I would talk about Bitcoin. So here we go. I know that there is a limited supply of Bitcoin, 21 million Bitcoins out there. I am aware that it's broken 20,000. So what we thought was a bubble several years ago, 3-4 years ago, when it broke, when it almost hit 20,000, it broke and went all the way down to 3,500. Bubbles rarely reflate. Well, this is reflated, so you can't call the previous high a bubble anymore. Is this a bubble? I don't know. The argument is that no one's printing more Bitcoin. That's it. That is what it is, and that of all the alternative currencies that you could be in, and gold is a form of a currency, silver is a form of a currency, any real asset is a form of a currency, because if you hold it, it should rise in value over time. That I think it hit 23,000, and I heard somebody on Bloomberg say they think the fair value of Bitcoin is 400,000, but didn't lay out their argument, and I've heard even 1 million. When you start hearing these wild, crazy numbers, euphoria is running the show, not fundamentals. And I don't even know really, truly what the fundamentals here are. I do know this, though. There is one gold. That's it. There's one gold. Sure, you can get more gold by mining more gold. You can always come up with more gold, and pretty much all the gold that's ever mined exists today. And there'll be more gold produced every year, but there is only one gold. But there are many cryptocurrencies. Each cryptocurrency may be a finite amount, but there's an infinite number of cryptocurrencies that can be issued. Facebook was talking about one. Apple was talking about one. Every company seems to be talking about one. Central banks are starting to look at this saying, well, why don't we do this? And so, I don't know. I really don't know the answer to that, but I do know this. I would not sleep well at night being long Bitcoin. Maybe you can. Maybe you can, but I can't. And like anything that has a great story, but little else, and sure, go ahead, hit the comment section. I can tell some of you right now are itching to hit that comment section saying, I don't understand what's going on. I don't get this. You're right. I don't understand it. I don't get it. And one of the rules I have is if I don't understand something, I don't trade it. I don't understand biotech. That's why I've never owned a biotech stock. Now, have some biotech stocks really, really hit and made it? Yeah, lots of people have made a lot of money there. I don't understand it, so I don't trade it. As Warren Buffett said, the best way to get out of trouble is to stay out of trouble. I know nothing about Bitcoin. What I do know is it's not the only one. And as I think about it, I think, well, what's stopping almost any company, any large enough company in the world, Google, what's stopping Google from introducing a cryptocurrency? What's stopping any of these companies? Amazon, why can't Amazon introduce a cryptocurrency? My God, it's the shopping market of the internet. Sure, all of them will be finite amounts of currency, but again, infinite types of currencies. There's only one gold, though. You can't introduce another gold. Look at, buy my gold. No, buy my gold. My gold is this, but my gold is that. So if somebody wants to, make a logical comment without calling me names, I'm telling you straight up, I don't understand it, which is why I avoid it. But to me, it seems that you could have infinite currencies. Where's the finiteness in that? Each one is finite, but that's all I can see. Anyways, I do hope that somebody can lay out a good logical argument without resorting to name calling. If your best defense is calling somebody else a name because they're not already saying what you already believe in, you're an idiot. Okay? You're an idiot, and most of what I'm saying is probably above your level of intellect. It's time for you to go somewhere else. I'm going to insult you before you insult me. How's that? Anyways, let's lay out this equation for next week. Okay, so nice blank screen, and we're going to put 4 letters on this screen, and those 4 letters will set up a fight between 2 schools of thought. On one side, we have the monetarists, and on the other side, we have the Keynesians. And they disagree on this equation. Let's take our money supply. This is the amount of money in circulation available to buy goods and services. And we can arrive at a measure of GDP if we take the money in circulation and multiply it by the velocity. Velocity is how many times it changes hands. So I take $10, I go to Tim Hortons, I buy some donuts. Tim Hortons then pays their staff and pays their suppliers, who then go and spend that money somewhere, and then those people spend that money somewhere, etc. So money changes hands a certain amount of times a year. So if we take the money supply, multiplied by the amount of times it changes hands, that's demand. This is the demand side of the equation. And this is level 1 macro, by the way. And that should equal GDP. Because GDP measures the goods and services produced and sold within the economy, produced within the economy during the given year. And if this is all of the money available and that's how many times it changes hands, the monitors are saying you have an identity. It should equal GDP. And what we'll do is we'll write price times quantity for GDP. Because if you take the price of everything, multiply the quantity sold, you should get nominal GDP. Quantity here is real GDP. P is the price level. This is the velocity of money, and this is the money supply. And this was the monitor school. The big person there is Milton Friedman, and he said that inflation everywhere is a monetary phenomena. So their argument is that, listen, velocity is fixed. The amount of times it changes hands per year is fixed. Now, they don't argue that it's fixed. They do recognize that in expansions, the velocity of money will increase. In recessions, the velocity will decrease. But that it is not enough to explain changes in the price level, so they say it's fixed. They also say that the real supply of materials, of goods and services in the short run is fixed as well, because you have to add capacity to scale up. You can tell that this was a pre-digital world where you don't necessarily have to add capacity to scale up. There's lots of businesses where adding the next customer, they don't have to do anything. They have unlimited capacity to add the next customer. I talked about this last week with companies that have marginal costs that are approaching zero. So when we think about a marginal cost curve, typically we think about it this way, and a company would want to operate at its lowest marginal cost. But in a world of digitization, you can have marginal costs that do this and that never turn up, or that do so way beyond the potential of any demand to overwhelm the supply. So you have ever increasing or decreasing marginal costs to almost zero in some instances. So in this equation, since velocity is fixed and the real supply is fixed in the short run, an increase in the money supply can only result in an increase in the price level, because this is an identity. There's the monetarists. Keynesians, on the other hand, say, whoa. First of all, this velocity argument that you have, no way. Velocity moves is just as variable as all of the other factors. In a recession, it drops. In an expansion, it rises. So I think you're wrong on that respect. Also, the amount of real GDP, or the quantity of material, fixed. Are you kidding me? It's not fixed. It's ever changing. So no, it can scale up and it can scale down. You have to keep your eyes on inventory and industrial capacity to determine where you're coming up against a constraint. But there's always cycles of investment going on that overlap, that the real quantity being supplied is ever increasing at any given time or ever decreasing. So they disagree with the monetarists on these little bars over the V and the Q. And they say that an increase in the money supply does not necessarily have to result in an increase in the price level. Now, if you think about how money supply is increased and how the Fed is doing it, it's really creating bank balances in essence, because it's buying these treasuries. So you have, or what you should have, is an expansion of credit. Well, if you increase the money supply but you don't increase expansion, you get a classical liquidity trap where that money is really just stuck in banks, and banks are saying, listen, we're not going anywhere with this. We're still going to lend only to people who can pay us back. Just because you're giving us more money to lend doesn't mean we're going to be stupid, okay? So you may end up with a liquidity trap, which then does not push up P, but actually pushes down P. So there's the argument, and we're going to see if we can get anywhere next week. We have the monetarist argument that says increases in money supply, increase in the price level. You have the Keynesians that saying, no, maybe it works that way, but to work that way, some conditions have to be present. Capacity utilization has to be very, very high. Inventories have to be below their average level. At that point, yes, you're going to need major investment in capacity increases. That's going to drive or that demand will pull inflation through the system. And next week we'll look at, when we talk about inflation, I'll talk about 4 types of inflation, and we'll see which one we think will hit the U.S. There is one, because we made the case today, U.S. dollar decreasing. Well, there is one argument that points to the currency as a catalyst for inflation. We'll see if that's enough. In the meantime, if you want to brush up on things, this is called the quantity theory of money. So if you want to do some Googling or even on YouTube, look at some other videos on the quantity theory of money, you can get a good background in that before I do that one next week. Anyways, I've gone really long now. I think we're an hour and 10 hour and 15 minutes. I know that some people have said, that they're willing to listen for as long as I'm willing to explain these things. But, after a certain amount of time, without really getting into a lot more of the gritty details, I've made the case with broad strokes. And if you want to learn more, it's all on the pages of the CFA curriculum at all 3 levels. So if you are a CFA candidate, going through these readings, don't look at them as something that you have to get through. It is not something you have to get through. It is something you want to get through. Not that you have to, you want to. All of this stuff is as real as it gets. So when you're watching Bloomberg and you're listening to these experts talking, you think, man, they really know a lot. It's all on the pages. You can know this too. As you're reading it, ask yourself, how does this apply in the real world? How would I think about something in the real world in this sense? And it's okay to head to Google and and look at a chart of something. At the end of every reading, there's a whole bunch of sources of where that information came from. OECD, central bank websites. Take a tour. Head to one of those and just look at the data that they have. Don't listen to somebody tell you. Go right to the source and have a look at the data. There's a lot out there. You can go right to the source of the data and you can make up your own mind about what it's saying. Okay, we'll end it there.